Welcome to Level 3, Lesson 4. My name is RIA the Trader from TradingWing.net. In this lesson, you will learn about support and resistance lines and their importance when it comes to trading. Support and resistance lines are a method used in technical analysis. So let's get started. Support and resistance is also known as SR. This refers to the price levels on charts that act as walls, preventing stock prices from getting pushed past a certain point. There are many means of finding support and resistance. To further break down what support and resistance is, support is where the price is held up or supported, whereas resistance is where the price is held down or resisted. If you refer to the image placed on the screen, you can see a blue line which identifies the support. As you can see, at the $51.25 mark, there is a support, which means that the price is being held up or supported at that point. We have now reached a point where we must make use of our charting platform. As I mentioned at the beginning of the course, you will be required to have a charting platform in order to successfully trade. Let's look at an example of how to find and draw support and resistance. The first step in finding reliable support and resistance lines is to find areas in which the stock changed direction. These are known as pivot points. Looking at the stock on the screen, we can see that there is a slight run-up in this region here. However, the direction changes right in this region. Therefore, this would be our resistance line as it resisted this area here. We then see a slight rundown, followed by a direction change here. This would be our next pivot point, so our support line would be here. If we proceed with the day, we can see that both the support and the resistance line played a critical role. As you can see, the price moved up and resisted this line here. The price moved down, broke below the support, however, resisted it here, and also resisted it here. The next step to identifying reliable support and resistance lines is to find areas or prices that were either supported or rejected numerous times. If we look at the stock on the screen, we can see that this price here was rejected numerous times. This would become our resistance line. We can then look at an area that was supported numerous times, and this area over here was supported many times. This would be our support line. Now, if we proceed, we can see that the stock bounced within this region many times, eventually falling below, but still serving as support and resistance generally. One thing to keep in mind is that support can become resistance at some point if the price falls below. The method I just showed is the simplest way to explain support and resistance. However, this does lead to misconceptions, and there are 5 common misconceptions amongst many traders. The first is that the more a price is tested, the stronger the support or resistance is. The second is that support and resistances are identified by lines. The third misconception is that once a support or resistance is broken, it will continue to move in that direction. The fourth is that volume is not used to confirm support and resistance. And the final misconception is that breaks are when the price moves out of the support or resistance line. Let's go ahead and look at these further. When attempting to determine the strength of support or resistance, the general assumption is that the more the support or resistance line is tested, the stronger the line is. This is true to some extent. However, based on my experience, my take is as follows. On larger time frames, such as the 4-hour, 1 day, 1 week, and 1 month, areas that are tested many times are stronger as they are confirmed by a long-term trend. Because we are looking at larger time frames, we must be looking at longer terms. On smaller time frames, being the 1 minute, 5 minute, 30 minute, and 1 hour time frames, areas that are tested many times are weaker as they are not confirmed by long-term trends. On the short-term spectrum, traders typically want to break above that price, and so that area is tested numerous times. Let's have a look at an example. In this example, we are looking at a smaller time frame. I have gone ahead and drawn the support and resistance lines. As you can see, the bottom support line is tested a lot more times than the top resistance line. Based on my experience and not the general assumption, this would make the support line weaker than the top resistance line. And as we can see, we broke below that support line and in fact broke well below that support line. In this example, we are looking at a larger time frame, being the 1-day time frame. I have again gone ahead and drawn both the support and the resistance lines. As you can see, the bottom support line is tested a lot more times than the top resistance. Because we are on a larger time frame, we assume that the more tests, the stronger the trend. This is proven by the breakout of the resistance, and again proven by the easy breakdown of the support over here. The same line that we said was weak over here was proven to be weak over here. The next misconception is regarding support and resistance being lines. The general assumption is that support and resistances are identified by lines and prices won't move past them if supported. Based on my experience, here is my take. Support and resistances are zones or regions rather than lines. This is because stocks can still trade slightly above or below the support or resistance lines. Let's have a look at an example. As you can see on this chart, I have drawn both support and resistance lines. But again, support and resistance lines should be considered regions or zones because the prices can move past them. This does not mean that they are no longer support or resistance. In fact, if we look at them as regions, they are still support and resistance. The next misconception is regarding what follows after a stock breaks either the support or resistance. The general assumption is that once the support or resistance is broken, it will continue to move in that direction. Based on my experience, here is my take. Stocks can do one of two things once they broke support or resistance. For starters, they can continue their run. But they can also not continue their run, as there is another support or resistance line immediately after. Let's have a look at an example. In this example, I have gone ahead and drawn a support line based on this pivot point. As you can see, it serves as resistance later on. If we are looking to break out and simply looking for a break to see a continuous run, as the general public assumes, we would soon be mistaken, as we can see an immediate pulldown following the break. What exactly is this caused by? Again, there could be an immediate resistance following the break of the initial resistance. If we go back, we can see that this region here is what served as that resistance. The next misconception amongst many traders is that volume is not used to confirm support and resistance. Based on my experience, volume is actually a critical tool to determine if and when support or resistance will break. Let's have a look at an example. As I mentioned before, volume is a great way of identifying if a break will occur, a break of the support or resistance. As you can see on your screen, there are some new bars added to the chart. These bars are known as the volume indicator. If the bars are red, that means that the majority of orders placed during this time frame are sell orders. If the bar is green, then the majority of orders are buy orders. So how exactly do we use volume to identify if a break will occur? The simplest way to explain it is that if the volume is increasing as we approach the resistance or the support, then we can assume that it will likely break. Let's have a look at this example where I already drew the resistance line or resistance region. As we run up on the first attempt, we can see that the volume does not really increase and rather remain stagnant. And again, this is confirmed by the failure of the break. On the second attempt, however, we can see the volume drastically increase as we approach the resistance line. At this point in time, we can assume that we will likely break that resistance region or resistance line. And we do exactly that. The final misconception is regarding breaks. What exactly is a break and how do you go about identifying one? The general assumption is as follows. If the resistance line is at $10 and the price is at $10.01, that is a break. The general assumption is that when a price moves above the resistance line or below the support line, we have identified a break. In my opinion, this is not the case, and I humbly disagree. Based on my experience, a green candle opening and closing above the resistance without any wicks touching it is a break. Based on my experience, a red candle opening and closing below the support region without any wicks touching it is a break. If there are any wicks touching or any part of the body touching the support or resistance, that is not a break. And that concludes this lesson.